exit cap rate 2.5, and it's like, holy smokes, like how, like why, like I mean, and of course you can sort of like in hindsight look at this, but there's just no good answers to that.
You're listening to Ice Cream with Investors, a podcast that is dedicated to teaching you how to better invest your money so that you can live a more intentional life. I'm your host, Matt Four, and it is my goal to teach and empower you to remove the roadblocks to your financial success. All right, Aleksey, welcome to the show.
Thanks for having me, Matt.
You got it. Well, we like to start with the difficult questions here. What's your favorite ice cream?
Chocolate, easy.
It's funny.
In fact, so I always tell my wife, if it doesn't have chocolate, it's not dessert.
I typically tell every guest, like, that's what I'm going to lead with. And right once I said that, you said easy. So I figured you had something in mind that you're going to go with.
It's just like, it's so like, I don't know. If it doesn't have chocolate, it's not dessert. That's the rule. By the way, my wife disagrees with that.
So my feelings on that are a little bit different. As I age, I used to think the same thing. If it doesn't have chocolate, it's not really a dessert. But as I age, everybody does chocolate. Can you do something else besides chocolate and make it satisfying as a dessert? That's the question.
That's fair.
For a good dessert.
Yeah. That's the bar. In other words, if it's not chocolate but still good, that's impressive.
Yeah, exactly.
Yeah.
Exactly. Now, especially if you start getting into the fruits, like if you can serve a fruit dessert and it's really good, that's pretty legit.
Totally. Yeah, I agree.
I don't know if you eat sushi, but I have a rule as well.
Yeah.
If I'm at a sushi place and it has a fruit on a roll of sushi, I always get it because that's so interesting. And if they can do it well, it's like the best sushi ever. Of course, if they can't, then it's like, that was.
I feel like I've never tried sushi with fruit on it. Is that a new thing? Maybe I'm like way behind. Like what kind of fruit? Like pineapples and oranges or what?
I see a lot of strawberries. Mango is obviously a good one. Coconut seems to work.
I guess I've seen. Okay, I've seen some of them.
Yeah.
I don't know if I've tried one though. Now you got me
Next time you're at sushi.
But when is the last time you ate sushi with chocolate? Just kidding.
Only for dessert. Well, tell our listeners, what's the scoop? What do you do today?
Yeah. Long short story is just advise LPs. So I advise limited partners like passive investors on existing transactions that they've invested in, and then any new transactions that they are considering. I would say probably 60-70% of the business that I do with LPs is real estate related, and then the delta is venture capital, oil and gas, like small business acquisitions, like all kind of ranges. Within real estate, as you can imagine, like probably about half is multifamily because that's where a lot of capital flows, and then the rest is everything you can imagine: industrial, hospitality, office, mobile home parks, industrial outdoor storage, whatever, the whole gamut.
Gotcha. Well, take our listeners back. Like, why are you certified to do this? Like, what was your real estate journey before you got into this?
Yeah, great question. I don't know if I'm certified. There's no certification. I think I'm decent at it, and so I decided to try and try to help people. So what got me into it was I worked for a public REIT before this. I ran called Store Capital, STORE, previously public company, now they went private. I led the underwriting team there. It was like a 20-person team that looked at any new real estate deals that went through. And basically, I led the team that tried to figure out what are the risks of this deal? Like, how do we poke holes in this to understand what might go wrong? How does that impact our risk profile? Is there anything we can do to mitigate that? And ultimately, I sat on an investment committee to decide whether we should buy or not, restructure, right? And that was a fascinating experience. There we bought somewhere between 1.5 to 2 billion a year in real estate. And then I also ran the $10 billion portfolio that we had outstanding. I think when I left, it was close to 3,000 properties in the US.
So just to clarify, 1.5 or $2 billion a year in acquisitions.
Yeah,
That's a
and
lot.
what's actually pretty unique, Matt, is like there were very like very smaller small acquisitions. In other words, I think average size was probably 10 to 15 million. Like we did not do big deals. We generally did not buy like big portfolios. So like there were very uh it was just like a combination of like a ton of volume. I mean, like at any given week I probably had probably 20 deals on my team, right? And then we would churn through them. Like I there was like four different teams under me, focused on different industries. Um, and yeah, I mean, roughly speaking, each team had somewhere between 3 to 5 any given week deals on their plate. And so you kind of get through it, then you take it to investment committee, assuming it gets approved, it moves to closing, and then you buy it. Or you sort of decide that it's not worth the risk, and then you try to restructure, or just pass. Right, like that was our job.
I'm assuming with that kind of volume, you've got some quick rules of thumb that in your position in that inside of that organization were yes or no. So this is going to be different than the conversations we have about LPs and what they can do. But for your position, I'm assuming like, hey, declining markets, we're not even interested. So a deal hits our desk, declining market, move past it and move on. What were some of those like rule of thumbs or like quick yes or nos that you could do to start filtering deals?
You know, this might sound strange, but like I think we were very picky on cap rates. In other words, if we could not get, so first of all, I should start with the property type was single tenant, number one. Number two, it was a very specific type of single tenant that is non-investment grade, right? In other words, you should think about like your local um, grocery store, like not a Walmart that's investment grade, but like a local grocery store or like a local childcare, a local gym chain, let's say, or a restaurant chain, right? So anything freestanding with a small business inside, or small to mid. Some of these were like owned by private equity companies, the KKRs of the world, but like that's sort of like who we dealt with. And so the reason why we went after that market is, and I say we, I mean I joined after the company started, obviously, but the rationale was we can get a much better spread between like going in cap rates and debt, especially when you consider like the fact that you can accumulate a lot of these and then securitize, which is like a fancy word for um, a lot of properties, and you sort of like collateralize a lot of them together and take one big piece of debt, and it becomes cheaper because there's sort of diversification across the assets. So because of that, like we were very, I think in even in 2020 and like 2021, where like cap rates were going crazy across real estate, I think the lowest cap rate we ever bought was like maybe 6.9, I think. Um,
Wow.
and like, I think I looked at a 6.8, but I don't think we ended up transacting on it. Like we were very picky. And that was sort of we don't even want to touch it because it doesn't make sense. I mean, like the spread didn't make sense. After that, and this is interesting, Matt, like the way that I was taught, like the business was founded by Chris Volk. He's like, probably one of the smartest people I've met. And he was always like just a big thinker. In other words, you need to understand the business that's sitting inside your real estate, right? Um, and you can always sort of figure out a way to make a deal work, right? So a big part of my job was to figure out, well, okay, like this is very risky and I'm very concerned. Like for example, like sometimes we would do deals like headed into bankruptcy, right? Like we knew going in that there's a chance of bankruptcy in year one, right? But you go through all the steps and understand the creditors and what will happen in bankruptcy, and you get comfortable with the fact that you will exit bankruptcy as the same landlord that you were going in, right? But that's like, like that's a big topic, right? Because you really got to be sure that like they're not going to reject your lease in the middle of bankruptcy. I don't want to like get into all the
Yep.
specifics and whatever. It's probably not for this podcast, but I mean like The thing that I want to say is, I think one of the biggest things it taught me is just the investment process. Like, no deal is perfect. Every single deal will have risks. The question is like, can you get comfortable with the mitigants of those risks? And I think I see this a lot in the LP world. Like, I think LPs like tend to think in very binary terms, and I really don't like it. It's like, it's either the deal is like a slam dunk and I'm going to invest, or like, oh, like, you're asking for a 50-50 split. You're crazy. Like, I'm not even going to look
Yeah.
at this deal, and like, and those, that framework, I just think is not healthy. Like, they all investments have to be thought of as like sort of on the spectrum of other opportunities in front of the LPs. And you're either comfortable with or not, but don't go to the extremes.
Yeah, and that's one thing I think I love about real estate is everything has a number or a solution to getting a deal done. So to your point, like,
Yeah.
hey, this company is about to go into bankruptcy, but we still like this deal because we're buying it at a 20 cap and we feel like we're going to come out on the other side of the bankruptcy in a better position if
Yep.
they renege on the lease or they can't pay for their lease or something like that. So it is really that, where does their deal one thing I've really learned about you and like about the material you produce out there is, here are the risks associated with them, and now how do you get comfortable with those risks?
Yeah, and not ignoring the risk, right? Like, I can tell you, I mean, my team produced, I don't even know how many, like probably hundreds of investment memos. I would imagine. I never counted, right? But like, um, there's no such thing as a deal with no risk. Every single deal on the first page had, these are the top 3 to 5 risks of the transaction. And they were like, Matt, they were like real risks. Like, this company is going into bankruptcy within 6 months, and it has 3 to 7 months of cash runway. And like, how do you mitigate that? Well, like, I mean, you have to really think about your position in the capital stack, et cetera, et cetera. Like, another one is like, well, this building is literally in the middle of nowhere. If it goes dark, it's probably worth 50% of what we have today, right? And this is what I like. I think in some sense I see this as my like, mission with the business is like, I'm never there to tell LPs what to do. I just want to make sure they understand what they're getting into,
That's
right?
right.
That's really it. Like, there's no perfect transaction. All have risks and rewards, but like, you should just understand what they are before you send the check.
So before we get into the LP side of it and some ways that LPs should be thinking about investing in these syndication deals or funds or things like that, you mentioned the word spread a couple times. That is one thing that I think I've learned a lot about over the past 4 years, is this idea of a risk premium associated with the spread. So can you talk a little bit about, first define what a spread is, and then how do we think about a spread when we go into a class A building in LA versus a class C building in the middle of nowhere that you were mentioning?
Yeah, so it's interesting. Let me start with the basics. So, generally speaking, a spread is the difference between like the cost of debt and the cap rate. There's like a lot of intricacies here, because going in cap rates might not be what you're trending to, or your annualized, or whatever. I'm just going to ignore some of these things for a second. So, simply speaking, it's like just the difference between those two numbers. What's interesting is that spread trends over time in very like difficult to understand ways sometimes, because at the end of the day, what a lender is willing to charge you is depending on their cost of capital, A, and B, their willingness to deploy, which is like sort of it's it's a it's a cost of capital, but also like a sentimental, not, I don't want to call it emotional, but it's sort of like macro dependent thing. Like, in other words, there might be a ton of capital that they could deploy, but they're too scared to deploy it right now, and they're just sitting, right? So that stops supply of loans, and then other people are all of a sudden they're able to increase the rates on what they charge people. Um, on the other side, you have the equity side, which is like you buy a building, and what cap rate does that trend at? Well, so obviously, as we've seen, like when generally speaking, it's not one-to-one relationships. The relationship is complicated, but the as rates came down, like in 2020, we saw cap rates go down tremendously, right? And so you sort of saw this like decrease in debt, and then like as soon as debt costs decrease, you look at your pro forma and you're like, oh, like, well, now I can pay more for that same building because my debt service, i.e.,
Mm-hmm.
debt costs went down. Okay, so that means I can pay more for it, i.e., my cap rate on existing NOI is lower, right? And then you sort of like had this downward trend, right? In terms of the risk premium across different asset classes, I think probably the best way to think about it is, well, I would say two things. First, you should make sure that the premium is there, because while we're on this topic, I've seen many cases of people buying down rates and not telling LPs about it, which in my opinion is not the same thing as a positive spread, right? Um, so I guess that's just like sort of a tangential point while we're on this topic. But assuming that there is a real spread, that gives you some space, right, for that risk to take place. And I think, how do you say this? I think the only reason, I don't know if maybe that's too strong. In the vast majority, if not all of cases, if you're talking about like retail LPs, I think it's very difficult to make the case of making an investment with a negative spread. Um,
100% agree. I
I mean, like I can see side cases, Matt. Like like it's a little complicated sometimes because you might go. It also depends on like what cap rate you're using, right? Like the existing operator that's selling might have like a terrible operation in place, and you expect to double the existing cap rate on in like a year, and then you might be willing to take that risk if you really believe in that thesis. But man, like you really got to vet that. You better be really sure that's true.
I mean, literally though, how many deals have come? So you advise LPs now when they're either in a distressed situation or about to make their first LP investment, and just want an extra set of eyes on it is kind of how I'll generalize what you do. I'll give you a second to
Yeah,
answer that here in a
yeah,
second.
that's it.
But from a retail LP standpoint, like real estate is not your primary job. It is not your primary focus. It is not what you do day in and day out. Investing in a negative leverage deal, I'm going to say 99% of the time does not make sense. So like, have you seen
Yeah.
deals from a retail LP standpoint that hit your desk that you're like, okay, this actually makes sense for a retail, doesn't know anything about real estate to invest in? Very, very, very rarely, I would think.
Yeah, very rarely. And again, I think all of those exceptions would basically be cases where like there's massive distress at the property, i.e., the trailing 12 or the T3 annualized cap rate is just like really bad, right? Because the NOI is just like not really there. Um,
Yeah.
but yeah, I mean, to your point, I think it's extremely rare.
Yeah. So one of the things I wanted to give you an opportunity to kind of describe what you do for LPs specifically in real estate. And then you've kind of written some articles about the LP mistakes that you see out there. So I'll give you a chance to kind of talk a little bit about the LP mistakes you see. But just know if you're a retail LP out there today and you see somebody that's going to buy at a 5 cap and their debt is costing them 7, it's probably not a good investment for you unless there's a lot of good reasons around it. But go ahead and maybe describe a little bit about how you kind of help LPs and then some of the common mistakes or questions that you see them asking you before they make their first investment.
Right. So just in terms of the article that you mentioned, I mean, people can look it up. It's top 15 syndication mistakes. I think just to highlight a few of them. Look, I mean, if you go back to like 2020 era, right, and you look at a lot of the deals that I'm seeing now as a result of advising LPs in existing deals that have capital calls, I would say 90% of them have um probably three characteristics of those 15. Number one is not so much experience with doing the work. So maybe it's a syndicator's first deal. By the way, while we're on the topic, nothing wrong with doing your first deal, but it is wrong for an LP not to understand that it is the GP's first deal, right? And not realize that increases the risk of this investment, right? That's what I sort of try to drive people. And if there's an increased risk, well, you better believe that something should compensate for that in the investment. So that's number one. I think number two, I mean, super common, cap rate compression, just like massive assumptions in, I'm going to buy at a 6 today, but in 2 years I'll be able to sell at a 3. If you point blank ask the GP at that point why, I'm actually not sure what they will tell you. I think they would just tell you cap rates have decreased. Like, look at the graph. Like, they're just going to keep going. Like, people love this area, and like it's going to be great. And here's my commentary on that. I would say nothing wrong with that. In other words, you can assume whatever you want, but you better explain what happens if it doesn't happen, right? That's the key. In other words, and from the perspective of an LP, you better understand that assumption is not a property level assumption. That's a macro assumption, right? There are things that the GP can control within reason. That's kind of complicated because, like, rents, for example, are dictated by what's happening in the marketplace as opposed to whatever the GP does. But they can renovate and they can make the property nicer, right? So it's a mix. But like, they have no control over what happens to cap rates, right? So you just have to understand what will happen if macro doesn't go favorable, right? That's number two. And I think number three, most common, is floating rate debt. I mean, that's the biggest one of the past 2 years. Again, nothing wrong with floating rate debt. It's a great instrument, but you have to understand the downsides. And by the way, I think the downside isn't so difficult to understand. It's called floating for a reason, right? In other words, that the rate is floating, i.e. it moves. And between you and I, Matt, I kind of wonder how many GPs that are, let's call it, like, slightly in trouble today to very in trouble today, actually ran like a deep sensitivity table on what will happen to this investment and like the LP's investment if rates moved. Now, just a caveat here, like, I genuinely don't think it's reasonable to sit in like November of 2021 and you're looking at a sensitivity table and you're like, what will happen if rates go up 500 basis points? Like, I just don't think that's reasonable, right? But I do think it's reasonable, especially if you're going in on a floating rate debt, to sit there and be like, well, like, rates have been pretty low. I'm buying into a floating rate loan. How much of the LP equity am I going to be able to return if rates move up by 300 basis points, right? And if you made that assumption and cap rate expansion assumptions, and even with that, you were able to return the LP capital back, and things did not work out because, man, like, it's been a wild 2 years. Like, I actually think that's a solid GP. You know what I mean? Like, there are investments that go wrong, and I think that's something that the LPs need to understand. Like, you can't predict everything, but it's definitely the GP's job to sort of predict what could go wrong and sensitize.
Yeah, I also think, so you're speaking about floating rate debt. I think we chatted about this last time you and I connected, was like the one thing I've learned over the past 4 years as well is this idea of floating rate debt. And it's not that floating rate debt is a bad thing. It's that it's a specific tool for a specific situation. And
Exactly.
what I mean by that is if you are going into a property and you're going to renovate, or you have a short-term business plan to add value to it, floating rate debt is a great thing, because you typically waive this idea of a prepayment penalty. We have a lot of folks that I've talked to over the past couple of years that are like, why didn't everybody fix their loans? And it's like, well, because you have these prepayment penalties on the back end, and they were selling stuff in 14 months. They couldn't predict it, that wasn't going to happen in 3 years, that they weren't going to sell it. And all of a sudden you could get an offer that could, it's 25% more than what you paid for it 5 months ago, but you can't do it because the prepayment penalty wipes out the gain. So
Yeah,
it's
exactly.
understanding that there are different tools in the tool belt for different situations, and knowing what you're getting when you're investing in floating rate versus fixed versus something that's cap rate suppression in a
Yeah,
specific market. I want
exactly.
to ask
Yeah.
this question around like reversion to the mean. And maybe this is just the way I kind of think about the world, but I generally think that every asset class and every class within that asset class in real estate has a cap rate that it should generally trade within. So, an example of that is I believe that in most areas, a Class C multifamily property should trade around an 8 to a 10 cap, maybe 12 cap if it's in a rural area. And I believe an A class property or brand new property in those areas should generally trade between a 3.5 and a 5 in a major metropolitan area. So
Hmm.
what we saw in 2020 is cap rate suppression. So those 8 to 10s were trading now at like 5.5 to 6. My
Yeah.
fundamental belief when I saw those deals is that we will revert back to the mean. So I'm just wondering, what's your thought process on like cap rate reversion back to a mean versus the idea of liquidity and debt cost, and maybe it never reverts back? Hey, fellow investors, before we dive into our next segment of the show, I wanted to take a quick moment to talk to you about a fantastic opportunity for you to invest with me. As you know, here at Ice Cream with Investors, I'm passionate about real estate investing and helping you navigate the exciting world of wealth creation through real estate. And that's why, for the first time, I'm thrilled to tell you about an opportunity for you to invest alongside of me. Over the past 3 years, I've been investing in multifamily, mobile home parks, car washes. I've even become the bank and lent out money to fellow real estate investors on a short-term basis. And now you can come join me. If you would like to jump on a call and learn more about this opportunity, head to icecreamwithinvestors.com/invest and find a time for us to connect. And now back to the show.
It's an interesting question. I don't know if I've thought about that deep enough to like comment. Um, I
Because
think
if you
the like maybe my initial gut response would be like the cap rate at any given point is really just an expression of a buyer's willingness to transact based on the future, right? And so, um, I think, I mean, that's how I think about it, at least, right? It's essentially sort of like a discounted version of their expectations in the future, right? Um, and if you think about it that way, you naturally expect expectations, like you're discounting expectations, but in some years those expectations will be really good, and in some years those expectations will be really bad, right? And so when expectations are really bad, you're like, well, I can't pay for this property, right? And all of a sudden demand drops, and like there's like supply demand starts getting back to equilibrium. So I think, I mean, at a high level, I think the idea is right. um I say that humbly because I feel like it's like a pretty complicated concept, and I only
very
had like a few minutes to think about it. But like, but yeah, I think it's right. I think it would be very difficult to determine what those cap rates should be long term. Like, what is the equilibrium? And I also think another thing that probably matters a lot is just like the needs and rent expectations, right? Which is sort of part of that discounting of future cash flows. But yeah, it's an
so
interesting question. Yeah.
here's my thought process behind it. Give you a little bit of secret behind the madness. Is you said like cap rates are an ability for a buyer and seller to transact. I think that's true, but it's also the willingness for the buyer to take on risk. And if we think
Totally.
about like a
Yeah.
Class C property that's 1970s build, or let's take it to the extreme, a 1940s build kind of thing, something is going to have issues in the future, well, then
Hmm.
you should demand a higher premium, a higher cap rate for taking on that risk. So what
Yeah.
I thought in 2020 and 2021 is that people had money in their pocket and they were discounting the risk because the loans got so cheap. but they were
Yeah.
forgetting that they were taking on the inherent risk of older property, bad neighborhood, lower quality from an economics position,
Yeah.
tenant base. So that's kind of how I came up with that thought process.
Yeah, no, it's interesting. I haven't thought about it that way. I mean, I think and obviously I'm sure you would realize this, but it's intricate, right? Because your your cost of debt went down, as you've noted, right? And just from a cash flow perspective, you could argue that they baked in some of that stuff. They probably baked in additional evictions, and they probably baked in, like putting in like a fancy fence, security guard, whatever. Um, and they probably baked in some of those assumptions. And even then, because cost of debt was so cheap, that acquisition actually made sense, right? So meaning that there's like ways to quantify some of that risk. um and even then, I think some of the, like there's properties being sold in Phoenix at like 4 caps. But if the debt was like 2.5, it's like at some point maybe that makes sense,
Yeah.
obviously with a lot more detail and analysis. I'm just saying, like, it's yeah, I mean, it's a complicated topic.
Yeah, let's just to pull on that debate just a little bit is,
Sure, yeah.
I buy that 4 cap in Phoenix. And again, we're talking Class C. Class A, that's a different conversation. Debt is 2.5. I fix that debt for 7 to 10 years. I go sell it. Now I'm at an 8 cap. I'm still lost half of the inherent value of the acquisition price because the cap rate doubled basically. Now you can make the argument like rents have gone up and NOI has gone up. So really that 8 cap is not a true 8 when you bought it.
Sure.
But I still think like the inherent assumption is that when the cap rate, nothing else happened to the property, just the cap rate expanded, you
Sure.
lost half the value.
Yeah,
So
yeah, no, so there's no question that's true. I think the subtle part, I think, of what you're saying is, like, it is the GP's job to predict to some degree, um, future cap rates at exit, right? And I just genuinely, I mean, I think that's pretty hard. I mean, like, if you ask the best economists in the world, they can't even tell you like what SOFR will be, like in a few months, right? I'm just, and I think if you take an average real estate person who's actually good at their job, um, I don't know if they're going to be the top economists. I would probably say they're not, right?
Yeah.
So it's like it's very hard. But to your point, Matt, like if you're staring at historically low cap rates, I think it would be kind of crazy not to do a sensitivity table about exit cap rates going up. I mean, I saw, like, right now on the capital calls that I advise on, I mean, almost every single deal is like entry cap rate 4, exit cap rate 2.5, and it's like, holy smokes, like, how, like, why, like, I mean, and of course you can sort of, like, in hindsight look at this, but there's just no good answers to that other than people wanted to buy, and it was good times, I guess.
Yeah. Well, in the business is hard, right? And I think
Yeah.
there's a lot of FUD and a lot of FUD thrown out there at operators and malicious intent versus a bad investment. And
Yeah.
there's a lot of LPs out there that are feeling like, hey, you're terrible at your job because you're not producing distributions right now, or the property has a capital call because the loan comes up or something like that. And I just want to like touch on this point that there's a difference between somebody doing the right thing and trying to make an investment and things just worked out against them versus, hey, somebody just took your money, ate the investment fees or the acquisition fees, did nothing to the property, and it went south. Like, we have to distinguish between the two in this society right now. And I think we were talking offline. Like, if you're a GP right now and you return and you bought something in 2020 through early 2022 and you return back LP capital, just returning it is actually really good right now. If you return it with some friends, that's actually going to look really good compared to the industry outside the Blackstones of the world that can just throw cash at anything. I think showing like a 5% IRR during these times is not a terrible thing because other people are having foreclosures and losing money hand over fist. What's your perspective from
Yeah, I
where
mean,
you sit,
I
though.
think a lot of this is pretty relative, and to your point, like vintage matters a lot. The best example that I can give is like, when you're looking at a track record slide, and it says, I had one property that was 1.1 times or 1.2 times, right? And the other one was 2 times. And someone responds to that and they're like, whoa, like that's a terrible average. Like these guys can't double their money. Like, well, what are these guys doing? And then you start looking at the table and you're like, well, they bought that 1.1 in 2007 and they sold it in 2015. So like all of a sudden you're like, huh, like, okay, like they went through the
The
recession.
GFC. Yeah.
Yeah, like they went through the recession and many people didn't make it through the recession. So like maybe it's kind of impressive that they actually got their money back. To and the 2 times someone might, see a 3x multiple, for example, on a track record and be like, wow, these guys are crazy, like best GP ever. I'm going to invest all my savings. And then you ask them like, hey, like when'd you buy the property? 2019. When'd you sell it? 2021. What was the NOI when you bought it? $100. When was the NOI when you sold it? $100. It's like,
Yep.
wait, so like how did you make a 3x? Oh, cap rates moved.
Market.
Oh, okay. So and all of a sudden like you start seeing like there's sort of like this relative relationship, right, between all these things. It's kind of complicated and intricate, I think. And to your point, I mean, I get probably one call a week at least that goes something like this. Like I pick up the phone and they're like, I heard about you, blah blah blah. Like I'm super pissed. Like I invested $1 million in so and so, and it's a total fraud. And I'm like, okay, like what's wrong? They're like, they stopped distributions. I'm like, okay, like sometimes it's good to stop distributions. Like sometimes it makes sense. In fact, it probably makes sense in the most cases when it's done. Like it's probably in the best interest of you as the LP to stop distributions. Meaning, obviously, it's not positive news, probably, and it probably does mean that the LP should look into the investment and understand what's going on. But it doesn't mean that they're a fraud. So they're like, oh yeah, but like I invested and it said 15% returns, and like it's been 5 years and I haven't gotten anything. And again, to your point, there's a fine line between investments that actually go bad, unfortunately, but had the right sort of fiduciary duty components, and what people would refer to as fraud.
Yeah. I think my favorite in that conversation too is like, well, a CD is paying 5%. And it's like, well, you invested in this in 2021 and a CD was paying 0.5%. So you didn't
Yeah,
have that
exactly.
option back then. That
Yeah.
should tell you right there that the market is at a different spot than, but
Yeah.
again, like distributions are not ideal. I'm in half a dozen investments right now that have paused distributions. But then when you look at the books, you're like, oh yeah, you've got $1 million interest rate cap coming up next year, and the
Yeah.
property is cash flow positive. And if you save all of that cash, you'll have 800K. Okay, you probably don't need to be sending me money, only just ask for it back later through a capital
Yeah.
call.
Yeah, that's what I'm saying. Like sometimes a pause distribution email means your GP is doing a great job,
Right, right.
right? Like
I want to
meaning they're doing the right thing.
I want to be cognizant of your time. So before we switch to the last round here, you also wrote an article, questions you can ask GPs if you're interested in this space. Maybe give us a couple of those questions that you feel like are very impactful that we should be asking GPs before we enter into a syndication investment with them.
I'll start with maybe the most surprising one. How does the GP get paid? And are you actually talking to the GP? Meaning this is like it sounds like so basic, but I can't tell you how many times I've gotten LPs that reached out to me on like a capital call, for example, and they'll say, "Hey, like I invested in so and so, and they just issued a capital call, and so I need to decide, and maybe you can help me decide." And I'm like, "Well, yeah, like you invested through them, but like who did you invest in?" And they're like, "What do you mean? I invested in that, right? And then you like, you look at the deck, and sometimes it doesn't say anything, which is, I think, not great, to say the least. But like, you just have to make sure that, like, whoever you're investing in, you have to understand their, either that's the GP. If it's not the GP, that's okay, but then you have to understand sort of like the intentions, and how this intermediary is also compensated, not just the GP itself. And that has a lot to do with sort of like the alignment of interest between either the two parties, GPLP, right, or the three parties with the intermediary in between. I think that's that's a very big thing. I think that was very much ignored, perhaps, or just not known about until it's too late in this latest run up.
Yeah. Well, we will link that article, as well as the 15 mistakes syndicators make, or syndications make. Top 15 syndication mistakes in the show notes there, so everybody can go check them out. And I'll give a plug for your Substack, even though you didn't tell me to. I subscribe to your Substack. I think you've got a very interesting way of kind of looking at everything and kind of figuring out how it all pieces together. Your last one you wrote specifically about fees was like, hey, you buy a property for $4 million, but it's got 10% fees on it. You sell it for $5 million. You think you got a gain, but actually after the fees, you're at a wash. So it's just understanding those dynamics that I think you do a really good job of breaking down.
Thank you. I appreciate it. Takes a long time.
But I want to get us to the last round. We're calling this the 4 toppings. Our first one is, what is your favorite book, or what is a book you've read recently that's given you a paradigm shift?
I think, I'm somewhat new in like the entrepreneur journey. And I really appreciated like Naval's commentary on all that.
So good.
So and it's kind of a book. It's kind of not a book. It's sort of like a collection of a bunch of his sort of his tweet storm, if that means anything to anyone. But I recommend that. I think I found it to be very interesting in terms of like business advice, how you should think about life. It was very like refreshing and easy to read.
Yeah, he's got a talk on YouTube that somebody compiled all those tweets, and it's like how to get rich without getting lucky. It's
basically what
3 hours. It's so good to listen to, though. Our second one is, what is the best piece of advice you've ever received?
I think it was while I was working. I was sort of, I guess, on the brink of quitting many times. And a mentor of mine told me, like, I think it's important for you to have stability now, and you should just do whatever to do a really good job at your role. And this is the interesting part that he said, is like, make sure that your boss is sort of like the most productive, and like sort of like he or she is like the shining star of the company, and don't take any credit for it. And at first, I guess at first glance, I was like, what? Like that makes no sense. Like, I need the credit if I want to get a promotion, blah, blah, blah. And he was just like, he just kind of shut me up, and he was like, I don't want to hear it. Like, just do this and call me back in a year. And, long story short, like, I had like a really good run at store. And I think it's probably in very big part to me following that advice. So I guess, for those people that are in sort of some sort of career where that's relevant, I think it's advice that's very worthwhile.
Amen. I think it's a Sun Tzu to never outmaster the master, or something like that. Maybe it's Machiavellian, but yeah, very formidable. Our third one is, what are you most proud of in your life?
Probably family. I spend a lot of time with like the Jewish community, and my, I have a wife and kids, and it's something that I spend like a lot of time on, and make sure that hopefully my kids grow up to be good people and they do the right thing.
I was looking for a way to add this into our conversation, so I'm going to use this inopportune time now to say, I thought it was going to be being a table tennis champion. Didn't I read that you were like a table tennis pro or something?
A long time ago. I haven't played so much recently, but But yeah, a long time ago. It was fun.
For 44 minutes, I've been waiting to sneak that in, so I had to sneak it in before we left. Our last one is, if you could sit down and eat a bowl of ice cream with anyone, dead or alive, who would it be and why?
I think it would be my dad. He passed away over a decade ago now. I think it's like it's a classic case of like you don't really appreciate what you have until it's gone.
Yeah.
There's like a lot of great conversations that I wish I could have with him, and I think that the chocolate ice cream would have to be there because he would agree with me.
Did he pass before you had kids?
Yeah. When I was in college.
Being on this side of the fence, I have so much more respect for my parents, and the conversations we have are so different. Mostly me starting out.
Yeah.
I'm sorry when I did this, because now it's coming back to me.
Yeah. I totally agree. Like that's another reason why I wish I could have that ice cream. Because it's like you have such a deeper appreciation for what your parents did, and like what you didn't do as a kid, right? And like you just have like a different perspective on life once you have your own kids.
Yep. So everybody take that as a way to go call your parents and thank them if they're still around. But I appreciate the conversation. I always love chatting with you. If our listeners wanted to reach out to you, learn more about you, or just get connected, where is the best place we could point them?
Yeah. So my name is pretty unique. You can find me like on LinkedIn and Twitter. I try to post every day. If you want to reach out directly, it's Aleksey, Aleksey at hey.com. And then the Substack that you mentioned is lplessons.co, which is CO at the end.
Perfect. We will link those in the show notes. And then Aleksey, thanks for coming on.
Yeah, thank you for having me.
Thank you for listening to Ice Cream with Investors. If you like what we serve you here, it would mean the world to me if you would like, subscribe, and leave a review on your favorite podcast app.